Hey everyone, and welcome back to the channel. Ever wondered what it actually means to trade Forex? It might sound complicated, but at its core, it's all about trading one country's currency for another. Today, we're going to break down the absolute basics, the different types of currency pairs. By the end of this video, you'll know exactly what people mean when they talk about majors, minors, and exotics. Let's get started. First up, we have the majors. Think of these as the superstars of the Forex world. Major pairs always include the US dollar on one side, paired with another powerful currency like the euro, the British pound, the Japanese yen, or the Swiss franc. For example, your USD, that's the euro versus the US dollar, or USD, JPY, the US dollar versus the Japanese yen. Why are they so popular? Because these are the most traded currencies globally, which means they have high liquidity. In simple terms, it's easy to buy and sell them because so many people are trading them. This usually leads to lower transaction costs, or spreads, which is a huge plus for beginners. If you're just starting out, sticking to the majors is a great strategy to get your feet wet. Next, let's talk about the minors. These are also known as cross-currency pairs. The simple difference here is that minor pairs do asterisk, not asterisk, include the US dollar. Instead, they feature other major currencies traded against each other. For instance, EUR/GBP, which is the euro against the British pound, or AUD/JPY, the Australian dollar versus the Japanese yen. These pairs are still quite liquid, but usually a bit less than the majors. This can mean slightly wider spreads. So why trade them? They offer great opportunities because their price movements can be driven by different economic factors than just what's happening in the US. For example, if you think the Eurozone economy is going to outperform the UK's trading EUR/GBP might be a move you'd consider. They add another layer of diversity to your trading possibilities. Alright, now for the exciting ones, the exotics. Exotic pairs consist of one major currency, often the US dollar, paired with the currency of an emerging or smaller economy. Think of pairs like USD/TRY, the US dollar versus the Turkish lira, or USD/MXN, the US dollar versus the Mexican peso. The word exotic might sound a bit risky, and to be fair, they do carry higher risk. These markets are less liquid, meaning fewer people are trading them. This results in much wider spreads and can lead to more volatile, unpredictable price swings. However, that volatility can also mean the potential for greater rewards if your analysis is correct. Trading exotics requires a bit more experience and a solid understanding of the specific economic and political situations of the countries involved. They're definitely for the more adventurous trader who has done their homework. So, let's do a quick recap. Major pairs involve the US dollar and are the most stable and liquid, perfect for beginners. Minor pairs, or crosses, exclude the US dollar and pit other major currencies against each other, offering different trading dynamics. And exotic pairs match a major currency with one from an emerging economy, bringing higher risk but also the potential for higher returns. Understanding these three categories is a fundamental first step on your Forex journey. Start with the majors, get comfortable with how the market moves. And then, as you learn more, you can begin to explore the minors and eventually the exotics. Remember, trading always involves risk, so never invest more than you're willing to lose and always keep learning. I hope this breakdown was helpful. If you got some value from this video, please hit that like button and subscribe for more content to help you navigate the world of trading. Drop a comment below and let me know which currency pair you're most interested in. Thanks for watching, and I'll see you in the next one.